It's a common narrative that the Fed has done a great job. Pat J. Powell on the back, congratulations that we've avoided a recession because of their policies. And I strongly suspect that keeping these rates so high has decreased economic growth. And lowering rates should be conducive to additional investment, additional risk-taking by entrepreneurs, and that's what we need.
Professor Campbell Harvey, professor of finance at the Fuqua School of Business at Duke University, and also author of the book DeFi and the Future of Finance. It is so great to see you again, Professor Harvey, and great to welcome you back on the show. Thank you so much for taking the time to join me again.
Well, I'm looking forward to it.
I am too, and I enjoyed our last conversation. And at the end, I was like, I have so many more questions for you, so I'm just thrilled to have you back. And Cam, I feel like so much has happened since we last had you on. So one of the things about this show is we usually just kind of start with the big picture, more of that macro view, where we are today in terms of the economy. You could throw markets in there as well. And you could take all the time you need to set the table when it comes to more of that macro picture, where we are right now.
Oh, well, that's going to take the whole time.
It could.
Where should I start? Well, actually, this week, a really interesting piece dropped by BlackRock. And part of it makes the case that this potentially is the end of the boom and bust cycle. And it's very provocative, and there's a lot of interesting reasoning behind that. The essential idea is that we should have gone into a recession in 2023 and maybe early 2024, and we didn't. And instead, we had fairly robust growth. So what's going on? And all of the signals were negative. The people expected a recession. The economists expected a recession. The yield curve, my indicator, was inverted since November of 22. And we saw layoffs, strategic layoffs. We saw investment growth that was negative in 2023. That's usually very bad news, yet no recession. So that's kind of interesting.
Mm-hmm.
What's going on, and they're making the case that, well, maybe this is the end of the traditional business cycle. So I want to unpack that a little bit because it is so provocative, and wouldn't it be great if that was really the case? So I've been in this business long enough that I've heard this before. Indeed, I heard this after the 2001 recession, because that recession was trivial. So we didn't even have a year-over-year negative GDP growth rate. And then if you go back to the previous recession, the 1990-1991 recession, that recession was also trivial. So the drawdown was minor. And many economists were calling this period since the mid-1980s the Great Moderation. So that we go into a different phase. And if you look at the history of U.S. economic growth, the volatility of the business cycle has definitely decreased through time. So if you look in, for example, the 1800s all the way through the 20th century, especially at the end, there were recessions every 3 years, and some of them very severe. And then into the Great Depression with the massive volatility, and then things kind of calmed down. And people saying, well, this is consistent with this trend of decreased volatility in the business cycle. And after the 2001 recession, 2003, 2005, people saying, well, this is the end of the boom and bust cycle, until the global financial crisis hit. And we saw the most significant recession since the Great Depression. So we need to be careful here, that I think you don't have that much data to draw from. And I do think it's premature to say that we're at kind of the end of business cycles as we know it. However, and let's kind of look at the other side. So the other side is that, and I think there's kind of like two factors that tend to moderate the fluctuations in GDP. The first one is kind of interesting, and it is a result of the country actually growing richer and perhaps more unequal. And that is that the drivers of fluctuations in GDP are really business investment and consumption expenditures. So I already said in 23, investment was negative, but consumption actually grew. And there were two reasons for that. Number one reason was that people were working through the COVID stimulus that they got, and that helped. But number two reason is that there's an increasingly large segment of the population that is relatively insensitive to fluctuations in the business cycle. And think of these people as like the super rich. So they've got lots of savings. And whatever's happening that's negative in the economy doesn't matter. It doesn't really change their behavior. Indeed, they might see some bargains. So as prices come down and certain goods. So this group of kind of high net worth individuals is kind of like skewing the consumption expenditures. So it actually looks good overall, but we need to be careful because remember, GDP is an average, right? It reflects like the average experience. So we say, well, GDP is up like 3% on a real basis. That doesn't necessarily mean that on a real basis, my income is up by 3%, even though this is the aggregate economy's income, like in a way. Mm-hmm. So I think that, potentially this group of relatively insensitive spenders tend to kind of moderate what's happened. So that's number one, and that's important. So the number two potential moderator is technological innovation. And the US has been a great beneficiary of technological innovation for a very long time. And people saying, well, the US has lost their edge. It's going to be innovation coming from somewhere else. And then we're kind of hit with two very significant innovations. The first one is playing out in terms of decentralized technologies. And these technologies right now are just focused on cryptocurrency and stuff like that, but it's much deeper. It's way deeper. And this is technology that will help businesses operate much more efficiently, reduce transactions costs, make a much better deal for consumers. That's kind of happening. And then we're hit with artificial intelligence, which is another like remarkable innovation. These going on at the same time. And this gives the possibility of boosts in productivity that we've not seen since the Industrial Revolution. So this is a really big deal. And if you think about it, given that this is offering a boost in growth rates, that you can have a slowdown. And the slowdown might be from 6 or 5% real growth to 2% real growth. So like a new version of a recession might be just slower growth. And this is the case that people are making, that the boom and bust cycle is gone. So usually the boom is high positive and the bust is significant negative growth. So maybe in the future, we're going to have very positive in the boom and then kind of a moderation of the positive in the new version of a bust. So that's the argument that people make. Now, for me, as I said, I think this is premature. We're not there yet. And again, I will make the case, just like I made the case for the business cycle affects different groups of people in our population differently based upon certain demographics. Well, AI is also going to have a differential effect. So it's kind of like the usual unwinding of technology, that those that can afford to use the technology will benefit the most from it in the short term. When we get to the medium and longer term, it becomes commoditized, and that's different. So there's two types of inequalities. So one is just like an income inequality, where those that can afford these new technologies will be able to use it for productivity gains. And there's another very interesting to me type of inequality. And this has to do with regional or international disparities based upon where you are in kind of research in this new area. And if you look at, in particular, the AI innovation, it's almost all happening from the US. Mm-hmm. And why is that the case? Well, the US has got a great track record. It's got, by far, the best universities in the world. It's got a regulatory approach that, at least historically, has encouraged innovation. And then number 4, and this is the most important, the US is willing to spend on research and development. And it is striking that we have companies in the US that spend more on research and development than some European countries. And I'm not talking about like tiny ones. I'm talking about large ones like Italy and France. And it's no surprise if you look at the most valuable companies in the world, 9 out of 10 are in the US. And it's all about growth, and it's about investing in research and development. So I see the possibility of greater kind of regional disparity. It's also, you see this in stock market valuations. You look at what's happened in the US market versus European markets or other markets around the world. It's the US going up, and for good reason. So the US traditionally has been more willing to take that risk, to make those long-term investments in an idea that it might take years to actually pay off. And I think that this is kind of the way to look at it. So I do think that going forward, that there will be some moderation in terms of the boom and the bust. We're not quite there yet, so it's premature to go there. And of course, the last thing is US is such a large country that there's diversification within the country. So very, very unique that the US is so diversified. People don't realize that the size of our trade sector is so small. You know, those tariffs that, we're talking about that the new administration might impose, well, like 14% of our GDP is imports. So it's really, really small. There are countries where over 100% is based on imports. So our international exposure is very, very small. So we're well diversified and on a very good vector. So it's kind of a long answer to your question, that I actually believe that the business cycle is not over yet. I believe that there are some structural forces that will lead to not just moderation, but increased growth. We've been stuck in this very low growth mode for quite a long time, where we applaud a 3% print as robust. And historically, that's not been the case, that we have had 5%, 6% real GDP growth. That's what we need. We need growth. And I do think that these new innovations, if they're handled properly, hold the potential for putting us on a new growth path. And I don't think I'm alone. I believe that many people, particularly investors, are seeing this. And when you kind of adjust your growth expectations, that creates a lot of shareholder value.
Wow. I have to say, Cam, I love listening to you. I didn't want to interrupt because that was phenomenal. And I know the audience is going to enjoy it as well. And you're teaching a lot of us so much. Let me ask you this, because you're right. That is a provocative piece that came out from the world's largest asset manager. Not there yet, but it is fascinating that you'll see that very positive boom and that moderation on the bust. On the growth side of things, now that we're past the election and we have Trump 2.0, the administration taking shape, what do you think the growth prospects look like just post-election, if you could go there?
So this kind of links to what I was saying a little earlier. I said that the U.S. has been the world leader in innovation. That 9 out of 10 of the most valuable companies are in the U.S. The exception is a company in Denmark that happens to do a lot of business in the U.S., and there are many competitors to them right now in the U.S. So we'll see how that actually plays out. But if you really think about it, and I actually confronted recently an important policymaker, a regulator in the European Union, about this difference between the type of businesses that do well in the US and in Europe. So you look at Europe, and some of the most valuable businesses are just, could be like fashion. And that's way different than designing chips and things like that. So designing chips are going to make you more productive. So it spills over, has this other effect. And I was talking about the significant differences in research and development. So you think of the European Union has got a much larger population than the US, but the US spends far more on research and development. So I said, but how can you expect to grow? So I said that we're kind of getting used to this lower growth, and 3% is robust in the US. Well, in Europe, it's 2% or 1%. So they're a very low growth trajectory, and Japan is even worse. Okay, so I think that the US has been a leader, and part of the reason is that the regulatory environment historically, and I used the word historically as a modifier before, has been fairly friendly to innovation. And it's let innovators do their job. In Europe, it's completely different. It is a regulatory state. And I believe that impacts negatively their innovation. And indeed, in this conversation with this regulator, the regulator admitted that was the case, but it was their choice. So they're choosing to have something that is a much safer environment, and they don't want the Wild West. Well, the Wild West has served the U.S. really well. And one thing that I had been worrying about for quite a while is kind of regulatory overreach in the U.S. And this is not just for corporations. It affects my business also, where there's like 400 regulations that Duke University needs to deal with. And we have to hire people that just focus on adhering to all of these regulations. And what does that mean? That means that there's less funding available to hire research scientists or to construct labs. So we see that the amount of innovation is decreasing, yet the amount of money on compliance, regulatory compliance increases. And this is the same thing that's happening in business. And I worry about that a lot. And indeed, there's no surprise that over the last 20 years, the number of public companies in the US has decreased by 50%, 50%. And it's just so expensive to be a public company in terms of regulatory compliance. So it's natural to go private. Or if you're private, don't go public. So the IPO is no longer as important. So again, I'm worried about this. And I do think we need a reset or at least a rethinking of the regulatory environment. And I think that the new administration will initiate that. And let me be a little more specific as to what I mean by that. So this is not a situation where you eliminate all regulation. That's dysfunctional. We don't want that. That's chaos. So there's a reason to have regulation, and very few disagree with that. So it can't be the case that I decide to burn my garbage in my backyard, and that decreases the quality of life for my neighbors. That's just not fair. So you need regulations for things like this. But there's a balance. So the balance goes like this, that if there's no regulation, then you'll get people taken advantage of. And we don't want that. However, if there's too much regulation, then companies will either not innovate, choose to do other things, or in the worst scenario, relocate offshore. And no country wants to lose their best ideas to go offshore. And we've certainly seen this in terms of the decentralized technologies, where we've had no regulatory guidance over the last 4 years, and a decrease in innovation and many companies just deciding it's not worth being in the US. That's not what we want. That's not what we want. So there's this balance. And the balance is to trade off the kind of consumer safety and the degree of innovation, and not to go too far in the direction of kind of overregulation, because you kill innovation and you cause companies to move offshore. And regulators that I've talked to, they totally get that. And to get that balance is difficult. But we need to think of this as what I call efficient regulation. So I do think that the new administration will take a look at the complex that we have right now and try to make it more efficient. They will make some mistakes. It's obvious, right? You have to. With 87,000 pages of regulation, you're going to make some mistakes in the things that you kind of turn off. So it will be an iterative process, but I do think that the goal here is to have a situation where we can innovate. And this is really important because we've got a couple of historic, our generational innovations going on, and we need to make sure that we don't fumble on this. It's the main thing I worry about. And I've been worried about this over like a number of years, that don't want regulators to put barriers up that causes growth to decrease. And let me just sidebar on the growth. I keep on talking about growth. Well, this is really, really important, because we've got $35 trillion of deficit, or of debt right now. And
36 trillion is crazy.
Over the last 12 months. So this doesn't make any sense to me, and I'm sure it doesn't make any sense to your viewers and listeners, that we're in a situation where we've got near record low unemployment, where we've got decent economic growth, like close to 3%, and the stock market is at like an all-time high. Yet we run a deficit of $1.9 trillion. The $1.9 trillion, I could understand if the economy collapsed. But no, it's not collapsed. It's actually a good situation. So what does that mean? That means we have a structural deficit, a very serious structural deficit. So the deficit's 1.9 trillion. The interest on the debt is $1.1 trillion a year right now, with an average interest rate on that debt of 3.5%. And we know with new deficits and rolling over a debt, that interest rate will increase. It's obvious. So this is a serious issue for the U.S. It was not an issue in the election. That was kind of surprising. It wasn't really addressed. But we're getting to the point where this will seriously crowd out economic activity. So what do you do? And there's many different options. So I will talk about three options. So number one option is to raise taxes to pay down the debt and to close the gap in the deficit. So that's a bad idea, because we know that that's going to kill economic growth. So and nobody wants to raise taxes. So, and again, no surprise during the election, neither candidate said anything about taxes. Number two, we're in this interesting position where half of our debt is owned by non-Americans. So why not just inflate and print money? And what does that mean? It means that you expropriate from the foreigners that hold the debt. And it sounds in theory a good idea. You'd slash the debt easily by 50% by doing this. But inflation is bad. It's bad for economic growth. It's like a tax that people pay.
Right.
And you saw with the last election that even with 23% inflation over the Biden term, that was enough to be a pivotal factor in the election. So number two idea is a bad idea. So it's basically just inflate. Number three idea is a good idea, and that is to grow. And if you think about what happens with growth, as people make more money, even though the tax rate is the same, the actual tax revenues increase. So growth is really important. So what we need to be focusing on are policies that deliver the maximum chance to grow. There are other things that we need to deal with that are uncomfortable to deal with. So, for example, the Social Security system will run out of money in 2033, 2034, something like that. And to me, this situation can be solved. And it is something that's not popular. And that is that retirement ages need to increase. And we solve this problem. If we don't do anything, by 2033, there will be a haircut for everybody getting benefits of about 30%. So that's not a scenario that anybody looks forward to. The alternative is, and again, I think it's reasonable for many different reasons. So think of the most basic, where we implemented these systems where you retire at 65 at a time when the life expectancy wasn't even 65.
I know, right? Yeah. 65
and
is
now
young.
it's dramatically higher.
Yeah.
And people are working. And actually some people actually like their job. And you don't necessarily want to stop working. You might want to cut back. That's fine. So I think that this is uncomfortable. Again, neither candidate during the election wanted to address this. And even post-election, there have been pretty clear signals that Social Security is not going to be touched. Well, I do think we need to deal with it.
It's probably because it's hard to get elected on the issue, I imagine. But maybe at some point we have to just have the conversation.
Yeah. So again, there's an opportunity to do something about it for a president that is like a one-term president, which is the current situation. But it's not just the president, obviously. It's the party, and it's pretty toxic to do this. But it's a situation where, I don't want to deal with it. My time horizon is 2 years or 6 years in terms of political office. We have to make these tough decisions. We should not be kind of fooling ourselves. We need to put our house in order. We need to run the government like a business, and we don't do that. And again, I'm hopeful that there will be some changes with the current administration. It is not so easy, even though you've got the House, the Senate, the executive branch. The margins are very thin in the House and the Senate. So it's going to be very difficult to make substantive changes. But if we can make some changes, and many of the regulatory changes are very doable, maybe we get on a better growth path. Plus, we've got these two great innovations happening. And so I think the prospects are good, but we do need to look to the long term. And politicians are very poor at looking at the long term. And indeed, business people are often not very good at it either, where the long term to them is the next earnings announcement.
Yeah, that focus on the quarter. Cam, a lot of folks who are watching you today, they're going to know you from the most famous recession indicator, and that is the inverted yield curve indicator, which you discovered during your thesis, I believe 1986.
Yes,
the indicator has been 8 for 8. We did just have the 9th inversion. Haven't seen that recession. So the question is, was it a false signal, or is it still too early to say? But yeah, did we see our first false signal since the 1960s?
Yeah, so it could be a false signal. It is a little too early to say, but just a little. I'll probably make an official announcement in April if there's no clear recession that it was a false signal. And that means it's 8 out of 9, which not too bad.
Not bad.
It is naive to think that such a simple indicator, where you look at the difference between a 10-year yield and a 3-month treasury yield, that's just like a simple number that you can see just casually on the internet, that is able to explain a very complex U.S. economy with perfection. So it's very, very naive to think that such a simple model needs to always give a correct signal. But let me tell you, and I'll probably write on this, and these are kind of the things that I'm thinking of as to why. So let's assume that we don't go into a recession in the second quarter of 25. And I do declare the signal to be a false signal. So why? And why is this time different? And it's, of course, the case that every time is different, but there are some very distinct differences. And really, what it has to do is the awareness of the indicator. That's, I think, a key component. So if you think about, let's say, the global financial crisis, we go into recession. The yield curve was inverted. It was inverted like 23 months before the recession started. So it was a very long and deep inversion. And people totally ignored it. And you go into a serious recession, and the CEO is talking to the shareholders at the annual general meeting, saying, look, we lost money. There's no dividend. We have to lay out people. We were blindsided by this recession. And not just us. Look at our competitors. They're in the same situation. They're blindsided too. So it was a surprise. And then you go forward to November of 2022. Yield curve inverts. And then the same CEOs in 2023, they said, well, this yield curve indicator is 8 out of 8. It's all over the news that this is a very significant negative signal. So we're not going to pull the trigger on capital spending in 2023, because who wants to be in the position of facing the shareholders when you made a major capital investment, potentially betting the firm in 2023, and you can't tell the same story to the shareholders? So, oh, well, we were blindsided by the recession. They just burst into laughter. Like, how could you not see that the yield curve is inverted? And it's like all over the news, the Zeta debate. Why did you choose to ignore that? So they didn't ignore it. And as I said earlier, the investment component of GDP was negative growth. Okay, so that is consistent, and it's a subtle argument. But what this does is when companies decrease their capital investment and make kind of layoffs that we saw, like 5-10% of the workforce in 2023 and part of 2024, these were designed as risk management. That if a recession occurs, the company is strong and it can weather a slower growth situation and avoid slashing employment. So that slash in a recession is very bad. It trickles all the way through the economy, and it causes the recession to actually be deeper. So given that the signal was popular, people engaged with it, they decreased expenditures, cut back unemployment. All of these things decrease economic growth, but it reduces the probability of a serious slowdown. So you're doing a trade-off. So in this sense, the yield curve signal is what we call a causal signal. So when it inverts, it actually causes a change of behavior that slows growth, which it did, and it also reduces the probability that we go into a serious recession. So maybe given this kind of new situation where this indicator is well known, it affects the ability to predict. And it's the so-called self-fulfilling prophecy. We've seen this with other indicators, and fine. So I'm totally okay. Obviously, look, I wanted it to be a false signal. Like, nobody wants a recession. Nobody. And recessions are poorly kind of categorized. Oh, well, negative 2% growth or negative 1% growth. No, you need to look at it differently. A recession is brutally painful for some families, where you get, potentially multiple people within the family laid off.
Yeah.
The psychological cost is unmeasured.
Yeah.
So we don't want that. So number one reason is that is this idea of the self-fulfilling prophecy and the yield curve actually changing behavior as it's never done before. And the second part of the potential reason is what we talked about at the beginning, that the mixing in of these technological innovations.
And remind me, the two innovations, one was AI. What was the other one?
Yeah, decentralized technologies.
Decentralized. Okay, got it. Real quick, just on this self-fulfilling prophecy bit. So during the financial crisis back in 2008, I think the last time you said there was somebody you had a contact maybe inside the Fed that was pointing to the yield curve and it was just flat out being like ignored. Did the yield curve, the inverted yield curve indicator, did it kind of grow in popularity post financial crisis because people were, it's been around for a while since your thesis, but just curious, like I was not a reporter back then. I was actually an undergrad, but I'm wondering, seems like more in recent years as a journalist, when I was a journalist, I'd often hear about the inverted yield curve in the, in the newsroom and the press, my own writing. Just, did it become more popular post financial crisis?
Yeah. So the financial crisis was pivotal because the yield curve had inverted well before the crisis. And I was saying that there was going to be a recession, potentially a serious one, and definitely a long one. And it turned out that the length of the inversion almost exactly matched the length of the recession. So it not only got an advance warning on the recession, it got the length of the recession. So people noticed this and said, oh, well, this indicator is 7 out of 7. We need to take it seriously. So there was another inversion in 2019.
Yes, I remember that. Yeah.
And I went on record, and it was all over the media. And I was not alone in predicting a recession in 2020. Because if you look at surveys of economists, people thought there was going to be a recession in 2020. Like 75% of our Duke CFO survey, for instance, said there was going to be a recession. But then COVID hit. So we'll never know. So that's kind of an event, an extraordinary event. So we'll never know the counterfactual as to whether a recession would have occurred even if COVID didn't occur. So that was number 8. And this is the 9th inversion since the mid-1960s. And again, it's, I think, likely a false signal. I've been talking about the possibility of a false signal since January of 2023. Because if you look at the fundamentals in the economy, they're fairly strong, especially on the employment side. So employment, you just can't look at the unemployment rate. You should look at the number of job openings. That is a crucial piece of information because the number of job openings can absorb some layoffs. So people get layoffs and the number of openings usually decreases also. But if the openings are sufficiently large, then people that get laid off can transfer to another job in a fairly short period of time. And that tends to moderate. Again, the worst scenario is where everybody is laying off and there's no openings. Yeah. And you take those consumers effectively dramatically decrease their consumption expenditure and consumption 70% of GDP, and that kind of cascades and makes a recession worse.
Mm-hmm. So maybe it's a good thing then if this causes that behavior change.
It is risk management.
Yeah.
Again, this is a very simple indicator. And I've long said, yeah, this is my dissertation at the University of Chicago. But if I was actually doing economic forecasting, I would look at the yield curve, but I would also look at a lot of other things. Mm-hmm. So it's not really what I do professionally, but there's other information that's out there that should be used. You put it all together and you come up with a forecast.
Yeah.
The yield curve has been very successful, but it's not the only piece of information, and it's naive to think that it is the only piece of information that's relevant.
Mm-hmm. Well, if you do an update to your piece in April of 2025, we would love to have you back on. Cam, the last time we spoke, we also discussed the Federal Reserve and, that they really needed to undo their policy mistakes. So I'm kind of curious to get an update on the Fed. We've seen the rate cuts since September. So just kind of curious your take on the Federal Reserve, their recent actions, and maybe your expectations.
Yeah, so it's a common narrative that the Fed has done a great job. Pat J. Powell on the back, congratulations, thumbs up, that we've avoided a recession because of their policies. And I think this is problematic on so many dimensions. So one of the issues is that we only see one observation of how history plays out. So what I'm talking about is the so-called counterfactual. So we know what we've experienced. The Fed hiking the rates at record speed, keeping the rates very high in a period where inflation had effectively come down to the Fed level, indeed in late 23. Yet the Fed just kept on hiking. So the counterfactual is, well, what if they didn't raise the rates as high, or they reduced the rates much faster than they did? And we're just at the beginning of the rate reduction. So what would the economy have looked like? And we don't know. But I strongly suspect that keeping these rates so high has decreased economic growth. And the logic is kind of finance 101. That if you increase the cost of capital, and your cost of capital is kind of anchored on kind of a so-called risk-free interest rate, like a Fed funds or Treasury bill rate, and then a risk premium that has to do with the riskiness of your business. If you increase the cost of capital, that means that fewer investments are undertaken. And investment feeds directly into GDP. And I've got research that actually focuses on that relation. So, the counterfactual could be that we would have had much more significant growth. So instead of printing 2.5%, it could have been 4%. And that makes a huge difference in terms of the standing that we've got, in terms of our debt, in terms of our deficits. So like in a way, we're just paying, like right now, the cost of the Fed policy of keeping the rate too high for too long. To me, the rate should be 3.5% right now. And this 25 basis points, will the Fed pause and a maximum of 25 basis points? It doesn't make any sense. You should just reset to what the rate should be. So a premium above inflation is reasonable, and 3.5 sounds about right. So again, we are focused on the wrong things. So we need to be focused, number one, on growth. And lowering rates should be conducive to additional investment, additional risk-taking by entrepreneurs, and that's what we need. And so I think that the Fed has done great disservice. It's really hard to prove because we don't know exactly the counterfactual, but we do have some pretty good intuition that higher rates are not conducive to economic growth or investment. And indeed, investment has not been robust.
Mm-hmm. Or even, someone like myself, a millennial that would like to buy a house, has not been the best environment either.
Yes, it's definitely the case. Though you get all these distortions. So the Fed, there's so many issues. So for example, I'm talking about the Fed kept the rate too high for too long. Well, they also kept the rate too low for too long. So they had effectively a zero Fed funds rate, 0 to 25 basis points for years. And again, it made no economic sense to me to have a zero rate policy when you've got robust economic growth, when you've got very high stock market prices and low unemployment. Like, what is going on? And then you see, and it's very predictable, and I've mentioned this so many times in my LinkedIn posts and stuff like that, when you have this unprecedented stimulus that was happening after COVID, we're going to have to pay the price. And we paid the price with 23% inflation. And the Fed was very slow to act in terms of raising the rates. So the rates should have been raised. And this 0% rate, there's so many distortions. So let me just give you two distortions. So number one is that when the rate is so low that many firms stay in business that should be out of business. These are so-called zombie companies. So given that the rate is so low, they've got just enough money to pay off or to pay the interest on their debt, so they don't default. And this is a distortion because it's much better for the economy for that firm to go bankrupt and redeploy the capital, redeploy the labor to more productive purpose. So that's number one. You keep these zombie companies that are low growth. They're not going to be contributing to economic growth. Low profitability. It's no good for investors. Yeah, so that's distortionary. And, excuse me. And the second distortion is in the housing sector. So you got a very substantial chunk of the population with a mortgage that's locked in for 30 years at less than 3%. And you think, well, that's a great deal. And it is a great deal, but it causes distortion. So think of it this way, that because you're locked in at that 2.5% rate, it makes it very difficult to actually move. Because you move, you're faced with 7 or 8% mortgage rate. So think of a person that gets a better job offer, so much better job, but they need to move to actually take that job, and they don't. So it could be a person that is underutilized. So they've got some skills, but they're not fully used in that particular job. Then they get the dream job in another city, but they're kind of frozen because of this distortion of like a 2.5% mortgage. And this damages economic growth. So these are just two examples of kind of the dysfunctionality of the Fed's policy. So the Fed kept rates far too low for far too long. And then they had to catch up and they increased rates at a record speed and then overshot. So the rate went up too high and then they kept it too high for too long. And again, you might say and make a reasonable argument that, oh, well, things turn out okay. And my response is kind of twofold to that. Number one, I've already discussed, and that is, well, the counterfactual might have been much higher growth during these years, and we would be much better off today in terms of having our fiscal house in order. And then the second issue is that we will pay in the future for this. So given the size of the federal debt, and given the pressures, the fiscal pressures, this will likely slow economic growth. It's not good. So again, there are countervailing forces that we talked about at the beginning, technology and potentially a more efficient regulatory environment. But nevertheless, these policies have been, in my opinion, not helpful. So the Fed should just stand down. It's much better, like, at least for me, to have some sort of mechanical rule. And it is, to me, very frustrating that all of the media focus is on what will the Fed do. So is it 25 basis points? Or what will they pull the trigger this meeting or the next meeting? Or every single word from every single speech that Fed officials make is processed through natural language processing to kind of figure out the real meaning of what they're doing. No, that should not be the focus. So our focus should not be on, well, what is the Fed going to do? Our focus should be on what are the policies that we need to create and implement to increase our economic growth rate. This is what we want. So we want the pie to increase. That's going to benefit everybody. Yes, there will be some inequality, but we want everything to increase. And that's not the focus of the conversation. The focus of the conversation is, what's the Fed going to do? No, that is dysfunctional. And I don't think the Fed has been helpful overall. Now, let me qualify that in a sharp crisis like the COVID crisis, I have no problem with the Fed intervening and providing much needed liquidity. So that just kind of reduces uncertainty and kind of smooths things out. But when the crisis is over, you need to withdraw that liquidity. And they failed to do that. It's also the case on the fiscal side that I can understand some kind of automatic stabilizers that you go into a sharp recession like we did in March of 2020 with COVID, that I can totally understand the federal government stepping up and providing some extra assistance to people in need. I'm very supportive of that. But then once we snap back, when we've got this record short recession, it was deep, but we shot back very quickly. It was V-shaped, a very skinny V-shaped. Then you lay off. But that's not what the government did. So they continued to spend, even though there was no recession. So again, these things are going to come back and bite us in the future. So I think the combination of the Fed's mistakes have been very costly, and I think there have been many fiscal mistakes that have been costly. Those are headwinds, both of those for the future. And we do have some positive momentum with technology and it's unfortunate, but the headwinds hopefully are overcome with the momentum, but the growth that we could experience with these technological innovations, I believe, is much greater than if we didn't have these hurdles in terms of both Fed actions and the fiscal actions.
Wow. I have to say, Professor Harvey, it's an absolute pleasure having you on every time. I took so many notes. I learned so much in this episode, things that I had not thought about or made the connection to. And it's just been a treat having you back on. And I know the audience is going to love it. I want to pass it back to you now. I know you write on LinkedIn. I know you have a lot of research as well. You also have the book. But maybe some parting thoughts for the folks who are watching and listening. Anything that you'd like to leave with them to, think about. It could be something from this conversation that you'd like to reinforce, or it could be something that we didn't bring up. The floor is all yours, Professor Harvey.
Sure. And I always enjoy talking to you, and thank you for inviting me. So I talked about a number of policy mistakes, both fiscal and monetary. I also talked about a lot of positives. So I think that for your listeners that are in the U.S., the U.S. is in a very strong position. We have the possibility of returning to growth that we haven't seen since the end of World War II. This is a possibility. And that growth could substantially pay down our debts. And I think the opportunities are vast, but there are risks. So I talked about one risk, and that is that the regulatory environment has been onerous and has disincentivized innovation in many different sectors. And another risk, I think, has to do with some of these innovations. So I do think that, for example, artificial intelligence right now is effectively unprotected. And I've thought deeply about this, and there are very significant risks to this technology being turned into a weapon. I'm not alone in worrying about this, but in the past, when we've had great technological innovations, the intellectual property was tightly controlled, like the Manhattan Project. Today, it isn't. It's effectively open. And I worry about some countries that are not particularly friendly to the US taking advantage of our intellectual property and weaponizing the AI. So I believe this is something that does deserve some regulatory attention. So this is not killing innovation. It's encouraging innovation, but also not letting people steal the ideas and potentially using them in a nefarious way. So all of this is about risk and expected return, the basics of finance. And I guess I've argued that, yes, there are some risks. Overall, the outlook is very favorable, in my opinion, over the next 10 years. So in the medium term, I think we're in good shape. And some other countries are definitely not in good shape that have failed to innovate or innovate in areas where there's not going to be a lot of growth. So I do think overall, we're in pretty good shape.
Professor Campbell Harvey, Professor of Finance at the Fuqua School of Business at Duke University. Thank you so much for being so generous with your time, all of your knowledge, your wisdom. We really appreciate you coming on again and look forward to seeing you again in the new year. Thank you so much and take care.
Thank you.